Good morning, everyone, and welcome to our DAT weekly market update. This is our update for June 20th, 2023. I'm Ken Adamo, Chief of Analytics over here at DAT. We have the illustrious Alex Perry sitting in for Dean Croak this morning. He's our Director of Analytics. And we have Chris Henry, very special guest, joining us from KSM Transport Advisors. He's the Chief Operating Officer over there. Good morning, gentlemen.
Good morning. Glad to be here.
Morning.
You stayed clear of those fires, right, Chris, up in Canada?
Yeah, we're getting the smoke today, and we had a little bit of a break last week, but it's been pretty brutal up until about Friday of last week. So,
yeah, I know you sent some of it our way, but we have I forget I'm missing his name at the point. We have Dean likes to bring Canadian guests on the show because it's such an interesting transport market, and we get so many questions about it. So I'm really thankful you're able to join us this morning. Do you want to give folks you're an industry vet, so I'd like you to do a quick intro so folks who aren't familiar with you and your work can get caught up.
For sure. Yeah. And thanks for having me on. Appreciate it. So I've been in the industry for 22 years. I started a company called Stack Up back in 2014. And what that did allowed trucking companies to compare and contrast their operating and financial performance versus other carriers like carriers. So that operating costs, activity-based costing, trucking is very near and dear to my heart. And I joined KSM Transport Advisors in 2002, at the beginning of 2002. And what we do is we help contract carriers with over-the-road, ad hoc networks understand their network profitability. So be able to basically handicap from a network perspective their lanes, their customers, or loads, tell them what they should do more of and what they should do less of, what's adding profit to their company and what's stealing profit away from their company. So that's my elevator pitch.
And that we all know is incredibly important right now when we're in a market down cycle to understand all of those costs and revenue drivers within a trucking business. So we're going to be really excited to bring you back towards the end of the show and dive in a little bit deeper for that. So there's already some questions coming in for Chris. Please drop those into the comment and chat below. We will circle back to those at the end of the show. But to get us moving along here, I'm going to dive into our key trends of the week. So van and reefer rates are mostly flat since road check week. I don't know that that's an overall negative, given that they had a bit of a run up there and have held, especially with the declining fuel prices. It's given some breathing room to those carriers that are out there running. I think volume is of probably a higher concern at the moment. West Coast ports and the labor unions reach a tentative 6-year agreement. It has yet to be ratified. We thought we were here before, and we all know what happened over the last couple of weeks. So it'll be interesting to see how that all pans out. As a nod to our friends up north, the Canadian spot market, May total volumes up 23% month over month, but still down considerably year over year. Canada to US down 32% year over year, while US to Canada down 55% year over year. Intermodal volumes for the 4 big US class 1s are down 10 to 11% year over year. And then the cash shipment index in May is up 1.9% month over month, but still down 5.6% year over year. And so now I will turn it over to Alex, who's filling in for Dean, to walk us through our market update. Alex?
Thanks, Ken. Yeah, we'll get started with the dry van load to truck ratio. The spot market volumes were at the lowest level in 7 years, following last week's 4% week over week decrease. Load posts were 16% lower than 2019, the next closest year going back to 2016. Dry van volumes have dropped 22% since Mother's Day. Carrier equipment posts increased slightly last week, decreasing the dry van load to truck ratio from 2.41 to 2.28. Moving on to the reefer load to truck. Reefer spot market volumes dropped by 5% week over week and are now 28% lower since Mother's Day. Like the dry van sector, reefer volumes are also the weakest in 7 years, impacted by lagging produce volumes, mainly in California, where the USDA reported volumes are 33% lower than last year. Carrier equipment posts were 3% lower last week. resulting in the reefer load to truck ratio decreasing slightly from 3.36 to 3.29, the lowest recorded since 2016, as we pass the halfway mark of the produce season. Moving over to flatbed. Flatbed volumes have dropped almost 20% in the last month, following last week's 13% week-over-week decrease. Load posts were 34% lower, excuse me, than in 2019, and 72% lower than previous year. Carrier equipment posts were flat last week, resulting in last week's flatbed load to truck ratio decreasing 13% week over week from 10.66 to 9.31. That's also the lowest since 2016. Moving on to the market conditions index, our MCI reported that capacity continues to tighten along the southern border for the fifth week, especially in the southwest and west coast, where combined regional rates increased by 2 cents per mile to an average of $1.86 per mile. Solid gains were reported in Arizona for outbound loads, which averaged $1.69 a mile, up 7 cents per mile week over week. Dry van capacity was tight in the Flagstaff market, where outbound rates jumped 23 cents a mile to $1.98. Loads west to Los Angeles were paying $1.56 per mile, the highest since January, and 14 cents a mile higher than last month. Flagstaff to Ontario was slightly higher at $1.61 per mile, which is 21 cents per mile higher than the previous month. Outbound California dry van spot rates reflect the lower import volumes, which were 20% lower than the previous year in the port of Los Angeles and Long Beach, where a third of the nation's imported containers arrive. At $2.09 per mile, California outbound spot rates were a penny higher per mile last week, 14 cents a mile higher than in 2019. Loads moved from Los Angeles to the two major spot market destinations, Stockton and Phoenix, have been increasing steadily for the last few weeks, resulting in spot rates increasing in the Stockton lane to $275 per mile, up by 11 cents per mile over the May average and the highest since last October. In contrast, capacity loosened in the Los Angeles to Phoenix lane, where spot rates averaged $2.58 per mile, down 13 cents a mile on the May average. Moving over to the reefer market conditions, at $2.39 a mile, outbound reefer rates in Georgia are identical to 2019, following last week's 3 cent per mile increase. Reefer line haul rates in Atlanta increased by 5 cents a mile the previous week to $2.13 per mile, with tighter capacity reported for the 440-mile haul to Orlando, where spot rates averaged $2.68 per mile, the highest since March, and 37 cents per mile higher than last month. Further west in Houston, spot rates at $1.89 per mile were 3 cents a mile higher last week, led by gains on the short-haul 200-mile lane to San Antonio at $597 a load, or $3.03 per mile. Spot rates are slightly higher than in May, but just over $130 a load, or 18% lower year over year. The USDA continues to report a slight shortage of trucks in Nogales in the Tucson freight market. Last week, spot rates increased by 5 cents a mile to $2.75 per mile, while loads to San Francisco were flat at $2.16 per mile. In contrast, capacity in the Nogales to Seattle lane has been tightening for the last 2 months, and at $2.66 per mile, line haul rates are the highest since last July and about a penny lower than a year ago. Outbound capacity continues to tighten in Fresno, where rates increased by 9 cents per mile the previous week to an outbound average of $2.41 per mile. San Francisco reefer spot rates increased by the same amount last week to an average of $2.35 per mile, with loads from Salinas to the nation's Salad Bowl to Hunts Point, New York, at the highest in 12 months at $2.29 per mile. Finally, over to flatbed. After tracking identically to 2018, Texas outbound average spot rates have lost 10 cents per mile since May, impacted by declining oil and gas exploration. The Baker Hughes rig count has dropped for the 7th week and is now 7% lower than the previous years. impacting flatbed volumes of steel pipe and casing destined for the Permian Basin, where over half the nation's drilling rigs reside. At $2.38 per mile, loads from Houston to Lubbock are at the lowest in 12 months at $1.35 per mile, and at $1.35 per mile lower than June last year. Excuse me. Dallas outbound flatbed rates increased by 3 cents per mile last week to $2.31 per mile, nearby Fort Worth rates increasing by the same amount to $2.29 per mile. Loads moving on the high volume lane between Houston and Fort Worth have decreased 9% in the last month, resulting in spot rates dropping by 18 cents per mile over the same time frame to an average of $2.79 per mile. At $2.58 per mile, outbound flatbed rates in Georgia are up 9 cents per mile in the last week, led by gains in the Tifton short haul market, where rates increased by 6 cents per mile to $2.57. In Jacksonville, line haul rates increased by 8 cents per mile to $2.40 per mile, while in the slightly larger regional markets in Montgomery and Birmingham, spot rates increased by a penny per mile to $2.81 per mile and $2.67 respectively. And that brings it to, I believe, I could be wrong, Ken, our question of the week. No, okay, my bad. Yes, I skipped a couple slides. Forgive me. The kicking it back over to you.
All right. Sorry for that technical hiccup. We're going to jump to the short-term forecasts. Just give our producer a chance to catch up. All right. So we always start with dry van spot rates. The blue line is the historical 7-day weighted moving average. We go back a few quarters to give you some historical context. Again, we're starting with dry van here. And then we have 4 forecast models, because it's fun to say 4 forecast live on air. We have our flagship ratecast model, which is in all of our products, from RFP Tool to RateView to DATIQ. We have the red line, which is our short-term forecast. We like this one because it really overemphasizes the short-term trends in the market and gives us an idea of what might happen if those short-term trends were to continue longer term. And then we have the middle two, which are blends of those 2 forecasts in various mixtures. So you can see here, the past few weeks, this section has been pretty easy because we've been seeing strong forecast alignment. And you're still seeing that pretty much heading up to the 4th of July holiday, but then you start to see a pretty substantial difference. Traditionally, at least at the national level, rates will correct hard pretty close to right after the 4th of July. 4th of July falls on a Tuesday this year, so I think we could see at least a few days of spillover. When it falls on a weekend, you usually pretty directly course correct getting into the new business week. These are the things that I fondly remember from working in an actual operation where you need to think about what day of the week holidays fall on. But you can see the ratecast model bounces back down after the 4th of July. The short-term model continues to show some strength. I think the middle models show a little more strength heading into the 4th and then a more tepid response after. Those are the ones, if I was plotting out the next few weeks of my internal forecast, I'd probably be erring somewhere between the green and the 2 middle forecasts. I think the red is a little overly optimistic, pending we don't get any kind of major tropical weather. There's 2 potential named storms brewing down there in the Atlantic, B and C. I forget what their names actually are going to be, but I think C is Cindy, but that could affect this as well. Let's get to Reefer. This is where the alignment differs even more. So all the models are the same. The blue line represents the same thing. You just see 3 of the 4 models are in alignment. That will see a strong run up to the 4th of July. Our flagship ratecast model is not so optimistic, I would say. It has a more tepid run up and then drops back, just like dry van. and the other one's not so much. One interesting note, if you're a bit of a technical geek like me, the red line does come back a little bit after the fourth, whereas if you remember on dry van, it didn't. That's just because the seasonal pull to come back, that overarching seasonality is much stronger on reefer after the 4th of July. So even the short-term strength that the models are seeing in that extreme short-term red model aren't enough to outweigh that dominant seasonality that the model's picking up on. Let's go to dry van. I'm sorry, I missed it twice. Let's go to flatbed. At least this one's easy. It might not be easy to say and transition to, but all of the models are pretty much in alignment. That we're gonna air back down. This is a very typical seasonal shape for flatbed. You see things run up in the spring as construction. There's a flurry of activity, and then it sort of wanes as we get into the middle parts of summer, heading into fall. That'll be really interesting to watch as we inch and inch closer to the fall months and how weather plays a part. Right, if we have a large property loss event with a hurricane, you will see flatbed typically respond pretty quickly and start to edge upwards. We have a special treat this week. A lot of people asked for our long-term forecasts. I'm just going to make sure that we're caught up on that from a slide perspective before I start talking. There we go. So this is our long-term forecast. The gray is the year-over-year change. Pardon me. The blue is that same actual, that 7-day weighted moving average. And then this is, I know it's a little weird to show both of these, but the 3 colored lines to the right mean something a little bit different. This is the ensemble that comes directly out of Raycast. So it's the high, medium, low out of our flagship model. It's kind of, if you think about it, you really can't do the red line that we just showed, the short-term model, long-term. It kind of doesn't make sense. It's right in the name. So this is our long-term Raycast model. So you can see the blue line is, the way I would think about this is the blue line is the base case. It's what the model expects to be the most reasonable projection going forward. The green line is an optimistic and the red line a pessimistic scenario. Not much has changed here, quite frankly. It expects us to be year-over-year positive sometime in the 4th quarter, and then dipping back down after the holiday season. That's the blue line. I don't think the green line here, the green dotted line, is overly optimistic, to be quite honest. I think that's very possible if we see any economic strength and a continued loss of capacity at the clip we're seeing it. I would say that, although I've been wrong before, the red line here seems quite wildly pessimistic. To think that we would go down below the depths of where we were when no one could buy toilet paper seems a bit unreasonable, but the model's viewing that as an extreme downside risk at the moment. Let's hit reefer really, really quick because I want to get Chris back here and get to the question of the week. The models are in tighter alignment here, at least through the holiday season and peak in the fall. Still, again, flipping year over year positive a little bit sooner, which is an interesting. I think you're going to see a lot of things happen in the market once a lot of brokerages, a lot of shippers, a lot of carriers track expenses and revenue and all of their operating metrics on a year over year basis. Once they start seeing some black as opposed to red, I think that'll be a positive for them. But then again, the red dotted line does show some downside risk leading into peak and then a pretty extreme amount coming out of it, which I think is unlikely, but important to note. That's a mouthful. If you have any questions about these long-term forecasts or you want high-res images of them, just drop us a note at askiq@dat.com. I'm going to bring Alex back on to read the question of the week while I grab a beverage. Alex?
Thanks, Ken. Yeah, the question of the week: how are contract truckload carriers adjusting to the current market?
Well, thanks, Alex. It's a good question. I would say the general feeling from our clients and the companies that we talk to on a regular basis is they're kind of shell-shocked. So the end of the year started with a lot of mini bid requests coming out, and that ramped up to record levels for most of our carriers, especially on the reefer side. And, kind of the general trend we're starting to see is large shippers awarding more freight to brokers. So they're trying to take advantage of the loose, capacity in the smaller carrier market. And as a result, our contract carriers, a lot of them are losing some lanes, losing some customers entirely, going from primary to secondary in the waterfall. And that's hurting them financially. So we work with 32 carriers ranging in size from 100 trucks all the way up to 1,200. So our hypothesis is that they're kind of skewing towards high performing overall in all markets. So to extrapolate that out to the rest of the industry, I would say that carriers, both contract carriers and those that tend to use the spot more, are in a world of hurt right now from a financial point of view. So my background is financial benchmarking, and I've kept a lot of conversations going with our clients that we work with on the benchmarking side, and there's not much black ink, if any, that carriers are experiencing right now. I had a conversation with a very large shipper last week at a conference, and he had said that they don't use brokerages to any extent. And I asked him for more specifics. And prior to COVID, they were around 9%, and now they're up to 22%. And that change really happened in the last year. So I think you're seeing a lot of similar tactics being used by large shippers. And as a result, margins on the brokerage side are really strong. So if you are a carrier with a brokerage, then you're able to recoup some of the losses you're seeing on the asset side in your network with higher margins. But I think what's going to happen is that higher margin is going to push a lot of the smaller, not as well capitalized carriers out of the market sooner rather than later. But we don't see a recovery, and we're not good at forecasting. We're good at reading what our customers are experiencing on a weekly basis. But from a forecast point of view, our customers are trending towards first or second quarter of 2024.
We're seeing the same thing, Chris, right? We have pretty much since COVID really got out of the quarantine and into the boom phase, where brokers are winning a significantly higher share of that RFP volume. And it's actually been second order helpful, right? Because most of that freight ends up in the spot market when they go to cover it.
Yep.
So it's been keeping the spot market a lot healthier. I mean, yeah, it is certainly a down cycle at the moment, but it's been keeping it from a volume perspective healthier than it would have been otherwise if they hadn't secured that contract freight. Mm-hmm. So we're seeing it pan out on both sides of the network.
Yeah, it's going to be interesting to see how it plays out in the next couple months. Yeah, the volume that the contract carriers have lost has gone to the spot market. They're starting to see that freight that they hauled the last 3, 4, 5, decade, showing up on spot boards with brokers. So it's going to be interesting to see how the capacity changes over the next 6 months.
So a lot of what we're reading is shippers need to be thinking about conditions changing in the next 1 to 2 quarters. There's a lot of advice, I would say, loosely term it as advice, a lot of being written, a lot of guidance being given to shippers around the fact that expect conditions to change. Is that something you buy into, or do you think it might be a little longer before they start to see tightening in their RFP processes?
Well, I haven't seen margins this strong since I've started doing benchmarking. So on the brokerage side, what that means is the smaller carriers are getting squeezed pretty hard right now. And the smaller carriers are the ones that a lot of them, purchase trucks during peak and, are being forced to stay out longer than they were a year or 2 ago. So I think what could happen is if that continues, if the capacity stays loose, you're going to see kind of a whipsaw event happening prior to the end of the year. So I think the holiday season, Thanksgiving season, should be pretty interesting from a contract carrier perspective. I think some are being optimistic that things will change quite rapidly, but our president, David Roush, is leaning towards second quarter of 2024. So I'm being a little bit more hopeful, but yeah.
Any thoughts or questions, Alex?
No, it's good to hear that the consensus is kind of unanimous. I guess that's almost tautological, but the opinion is unanimous about where we are in the market cycle, how we feel some of those carriers are being extended longer, and when we think the recovery will be. So I think we're covering it really
Chris,
well.
Good point, Alex. Chris, we are seeing the broker margin starting to compress a bit. The last month we saw probably 100 to 200 basis points get shaved off that margin. I don't know if it's just because it was a busier month and the rates and the fuel and kind of all those dynamics. We'll see if that holds. But is that something you're seeing in I don't know how often you rerun your benchmarking data, but
we're not seeing that right now. So margins, we track on a weekly basis those carriers that have brokerage operations, and those margins have stayed strong the last 2.5 months. And again, above the norm, and I would say record based on what I've tracked over the last decade and a bit.
So there's this period, right? I mean, there's kind of like 4 phases of any market where you have like high volume, low margin, low volume, low margin, high volume, high margin, and high margin, low volume, right? So we're seeming to enter into that, what I call like for lack of a better term, like the armpit of the market, where broker margins, as the spot rate enters that recovery, the margins will erode and the volumes will not have caught up yet. So they'll be in that low period, which tends to be kind of some of the toughest period for brokers to weather. Do you see, based on the fact that the market's moving a little slower than we may have expected in recovery, would you anticipate that period to be shorter or longer than historically average?
I think it will be shorter. Again, going back to my first love, which is operating costs and activity-based costing. The large contract carriers are not, or probably on average, not generating profit right now. So if you extrapolate that again out to the larger market, you're seeing more smaller carriers generating losses upon losses upon losses month over month. So they're having to stay out longer again. They're generating losses. They're wondering, is this for me? Why did I get into this? It's time to just hang up that plate. So I think that trend may be happening a little bit quicker than we anticipated. So again, I think the market will run up towards the end of the year, but who knows?
We're getting that question, and this is a dangerous time period to price when you're a broker, right? I used to, so you have a love for operating costs. I have a pricing background. Mm-hmm. So pricing deregulated energy and eventually getting into pricing asset and non-asset freight. So on the revenue side. And it never worried me pricing when the market was an all-time high, because I knew at any contract longer than 6 to 12 months, I was going to make out on the other end of it, right? So right now, the pricing guys and gals at these brokerages are heroes, because they priced a lot of this freight 8 to 12 months ago, and the market has done nothing but fall. Margins are at an all-time high. So that was a great time to be a pricing person. Now it would scare the crap out of me to be a pricing person, because sometime in the next 12 months, the market's going to turn up, and whatever threading that needle, right? It's a lose-lose situation, because in theory, you would want to price above where the market is now, but you're pricing against knuckleheads who have no idea what's coming and will price low and then, flake on their contract. So what advice would you give these brokers to, for lack of a better term, keep their powder dry and be smart about how to price in this transitioning market?
Well, my perspective is on the carrier side and then the asset-based broker side. So I think one of the traits that we see among top performing companies that have both is a centralized pricing model. So being able to identify what their core network is, and it doesn't matter if it's 10 trucks or 3,000 trucks, you need to know which areas you can generate the most density in terms of load volume, and that density drives efficiency drives velocity, and then eventually profitability. But for that freight that you can get awarded that falls outside that network, you need to be using that on the brokerage side. So having a centralized pricing model like an actuary at an insurance company is one of the traits that we've observed within these high performing companies. So what that also does, it eliminates the finger pointing. So that behavior that you talked about, where you win and loss, up and down all the time, everyone's on the same page with a centralized pricing model. It's not finger pointing when the market takes a downturn. It's a model like the insurance industry, whereby you're elevating that role to an executive level, the pricing role. You're taking into account the external benchmarks. You're taking into account your true operating costs, and you're defining what that network is. And as a team, you're all on the same page. So that might be more of a strategic answer to your more tactical question, but that's our observation in the market, how to approach pricing from a long-term sustainable profit perspective.
That makes a ton of sense. All right, let's get to
Can
some
I
of
ask
the
a
audience
follow-up
questions.
question?
Oh yeah, please, Alex. And then
Sorry,
I was going to mention too, Alex is an actuary, so it's actually funny
I
you mentioned
was. That's my old life. You said actuary, and I perked right up.
I know.
So, yeah, my follow-up question is from same perspective. How long should one stick with a model before pivoting, and vice versa? How kind of quickly should you?
Well, I think first of all, you need to have collective buy-in from the different operating groups within the company on a price or a set of price. But I think you're always pivoting, just like, an actuary, using that analogy, is always consuming data and updating their model continuously. So you're taking into account the external factors, external market indexes like DAT, but you're also taking into account how quickly your costs are changing. And the one thing I want to dispel the myth is that all these carriers just made out like like bandits over the last 3 years in terms of their operating ratios. It's not what happened. Their gross margins went up, dramatically, but in all that chaos of all that freight, good paying freight, there was a lot of friction costs involved in keeping that in terms of profit. So they had to go get more drivers, or try to get more drivers. They had to recruit through a lot of compensation. Some driver compensation went up 33%. So gross margins may have almost doubled during the run up in terms of rates, but net margins went up, 10, 15% overall. So very minuscule changes in terms of operating ratios over the last couple of years.
All right, let's get to some audience questions. From Matt Clark, Georgia Bulldog superfan. Chris, I've enjoyed reading your 12 traits articles. When is the next one coming out?
The next one's coming out this Friday. So that will be the 6th trait, and that's going to be focused on what we call the courage to shrink. So why we're in the mess we are today is because part of it is because a lot of capacity entered the market when the rates, jumped up. And it wasn't just small operators, it was large carriers. The big guys added capacity just like everyone else. And, trucking supply and demand. So one of the things that we've recognized, high performing carriers like, as an example, Heartland Express, they have what they call a minimum margin threshold, or what we've called, of our interpretation of their margin or their model, is a minimum margin threshold. So if they can't obtain that within their core network, they're going to not add trucks, and in some cases shrink their fleets. But that involves a lot of discipline, a lot of difficult conversations, because that also means that you're possibly eliminating drivers as well as non-driving staff. So, but from a sustainability over long term, the courage to shrink is a very key trait of a high-performing trucking company. So that's coming out Friday, Matt.
Awesome. Yeah, if you could send that over, I'd love to.
Yeah, we'll subscribe you to get them all.
Yeah, I'd love that. Yeah. There was another question in here. Kamikaze Productions, when do you think the next spike in the spot market is going to be? Which I have an intermediate question there for Chris, and I'm not going to hold you to it, but do you think the Teamsters strike UPS this summer?
I don't. Yeah, that's kind of out of my wheelhouse. But you'd be better positioned to answer that, Ken.
That's why I'm asking a bunch of industry folks. It's hard to read, right? I mean, if they did, that could really change the answer to this question and bring it forward, right? I mean, that would be a massive labor dispute that would spill over into the spot markets for sure. But let's put that on a shelf. Let's not actually answer that and get ourselves in any trouble here and paint ourselves into a predictive corner.
Well,
absent a major strike.
You can state that, these disruptive, not black swan events, but these big disruptive events, if they do occur, carriers, whether they're on the LTL side or on the truckload side, do benefit. Same thing with hurricanes, big weather events. So it does have the opportunity to change things very quickly.
Yeah, certainly, no doubt about it. And if you look back, there's been these catalysts the last couple of freight cycles, whether it was ELDs and tropical weather in 17 or COVID,
Mhm.
and things can whip into a frenzy. So, I mean, I think that outside of that, you're probably looking at early next year before we start to see anything resembling a spike, wouldn't you say?
Yeah, I agree.
All right, a couple more I want to do. Jeff Dickinson, friend of the show. Why would you lock in long-term contract rates in this market? I have a very good working relationship with my clients that know if the market changes, so does my rates. They are in agreement. I am talking long-term business. It sounds like Jeff has smart clients. I would say that doesn't necessarily permeate to everyone in the industry.
No, and that's the thing. Like, the more trucks, the more people you have, the more pressure there is to get what you can in markets like this, and it becomes like a self-perpetuating situation. So the other thing too is there aren't long-term, events like he's inferring to right now. A lot of it is mini bids. Your colleague Chris Caplice has a great article on the history of truckload procurement. And the way I see him kind of interpreting where we're going long term is a hybrid of contract and spot rates down the road, whereby you're going more frequently back to the market to see what you can get. So more dynamic, like airline type pricing. So if you can lock it in, if you have dedicated opportunities, do it. So Jeff, go ahead and get that while you can. But I don't know. There's really not a lot of long-term stuff happening right now.
Yeah, I mean, look, the cold hard truth of it is negotiating leverage rolls uphill in this industry, right? The small carriers have the least, large carriers have slightly more. In the spot market anyway, brokers tend to have more than those folks. And then above all else comes the shippers.
Yep.
And right now, if Walmart and Target and these folks decide they want to go 12 months, guess what? They're going to find carriers and brokers willing to lock in for 12 months. Just like the Men's Warehouse guy, I guarantee it. So that's just the dynamic of the market. And I love your approach, Jeff. And I think that's great advice for folks looking to break out of that cycle, but it doesn't mean that most folks aren't going to be subject to the overarching constraints that the market gives them.
In my final point on that, there's pockets of carriers that have been unaffected by the last 3 years of up and down and 4 years of rate roller coaster. They found niches, established really strong relationships, kind of become semi-private fleets for certain shippers, and they've done very well. We see some very specialized carriers with operating ratios in the 60s. So you got to find that niche just like any other business, because it's very hard to have a competitive advantage in trucking. If you can get that, go after it and try to insulate yourself from all this chaos that's happening right now.
For sure. All right, we're over. This was a great conversation. We'll love to have you back later this year. Plugs, Chris. How can folks get a hold of you and KSM and all the stuff you do?
Yeah, ksmta.com or freightmath.com, and subscribe to the Freight Math News newsletter. It's going out this Friday. Scroll to the bottom of the page, and we'll connect that way.
Awesome. Thanks for joining. Alex, thank you for joining. I know they're really big shoes to fill, filling in for Dean, but you did a great job. I appreciate you coming on, especially super early your time. Dean's long form market update, being the stalwart analyst he is, has been fully prepared and will be posted online this week. But if you have any questions or if we missed anything, it's askiq@dat.com. I will be attending my first FreightWaves event this week. It's in my backyard, right up there in Cleveland. So I'll be driving up there tomorrow. Seems like a pretty exciting schedule. I've never been to one. So I'll be the 6'4" dork walking around looking at all of the different booths and attending the session. So please stop by, stay high. Love to do some networking and maybe grab a drink afterwards. So with that, we're going to sign off this week. We will see you next week. We hope you have a safe and enjoyable week. And again, stop by and see me at FreightWaves if you're up there. Talk to you later. Bye.